This summer, Europe is sweltering again. Cities are baking under relentless heat, forests are going up in flames, and the air hangs heavy with humidity and haze. Elsewhere, the heat index has pushed past dangerous levels, setting new records almost weekly. But somehow, none of this shocks us anymore. Climate extremes have become background noise, abnormal yet expected. And yet, for every climate summit, every green promise, every corporate pledge of net zero by 2040, something feels off. While citizens struggle to stay cool, companies quietly pay to offset their emissions by funding forest preservation thousands of miles away. Except those forests are sometimes imaginary, or already protected, or burned down last year, and the carbon credits still sold. There's a pattern here of green money, green metrics, and green marketing, all consolidating into a global system that looks less like a climate solution and more like a climate cartel, a select group of nations and corporations writing the rules of sustainability, deciding who must pay, who gets to pollute, and who's conveniently left out of the conversation. Today, on Thread by Thread, we unravel that power structure, how climate has become currency, and why those trying to live sustainably are often the ones left paying the price. Welcome as you're listening to Thread by Thread, a podcast where each episode unravels a new thread, connecting stories of power, people, and the forces shaping our world. I'm Dheeraj Kumar. Imagine trying to fight climate change with the tools of high finance and global trade. In theory, money can drive solutions, put a price on carbon, reward green companies, fund climate projects, even tax imports from polluting industries. These are the ideas behind carbon offset markets, ESG investing, climate finance initiatives, and carbon border adjustment mechanisms. They are all designed to harness market forces for the planet's benefit. We are diving into how these financial mechanisms are supposed to work and why the reality often falls short. Let's start with carbon offsets. The premise sounds straightforward. If you can't cut your own emissions enough, pay someone else to cut theirs and call it even. Companies purchase carbon credits that fund projects like tree planting or renewable energy elsewhere, claiming those offset their pollution. The goal is to make emissions a tradable commodity, creating a financial incentive to reduce greenhouse gases. In practice, however, carbon offset markets have been plagued with issues. Recent investigations reveal that many offsets don't truly deliver climate benefits. For instance, a 2023 analysis of forest conservation projects, the kind big firms buy to offset their carbon, indicated that over 90% of these credits did not represent real emission reductions. Some projects overstated their impact or protected forests never truly at risk, yielding phantom credits. In one case, communities in Peru even faced forced evictions under a carbon project, a human rights fiasco tied to an offset scheme. So while carbon markets channeled billions into forest protection, a huge share of those green credits turned out to be hot air. Companies like airlines or oil majors that touted carbon neutral claims by buying such offsets are now accused of greenwashing, painting themselves green without cutting emissions. Regulators have noticed in Europe the advertising watchdogs and lawmakers are increasingly skeptical of carbon neutral pledges based solely on offsets. The idea of offsets is alluring. Money flows to climate projects elsewhere, but the execution has shown serious inefficiencies and even unintended harm. Next up, ESG investing. That's environmental, social, and governance, which has exploded into a major movement on Wall Street and beyond. The concept is to rate and invest in companies based not just on profits, but on their sustainability and ethical impact. In theory, ESG criteria channel capital toward cleaner, more responsible businesses, making polluters reform or lose investment. By 2022, ESG assets worldwide had surged past $30 trillion, and every big bank and fund seemed eager to brand their portfolios sustainable. The momentum was huge, but by 2023 and 2024, cracks began to show. Investor skepticism grew that some ESG funds were just rebranding old products, or that companies got high ESG scores for good governance while still polluting heavily. In fact, late 2023 saw the first ever global net withdrawal from sustainable investment funds. Money flowed out after years of growth. By early 2025, sustainable funds saw a record $8.6 billion quarterly outflow. Why the pullback? Partly a political backlash, especially in the US, where some states accused ESG of being a climate cartel imposing liberal agendas, and partly the realization that ESG wasn't always delivering real world emissions cuts. There were also inconsistent standards in Europe and worries about greenwashing. Companies might get high ESG marks for, say, diversity and board structure, while their carbon footprint remained massive. So while ESG investing was conceived as a financial force for good, it struggled with murky definitions and the unintended consequence of giving some polluters a pat on the back without deep change. The promise remains: ESG could drive corporate climate action, but the execution needs rigor to avoid becoming mere PR. Now, what about climate finance in the global sense? The flow of money from wealthy countries and big institutions to help developing nations cut emissions and adapt to a warming world. This was a core pledge of the Paris Agreement era. Mobilize $100 billion per year by 2020 so poorer countries wouldn't be forced to choose between development and green policies. The good news is that after years of missing the mark, developed countries finally reported surpassing that $100 billion goal. In 2022, about $115.9 billion was provided or mobilized for climate needs in poorer countries. That's a notable jump, 30% more than in 2021, and came 2 years later than initially promised, but at least the number was met on paper. The bad news? Much of this finance didn't arrive as no strings attached aid. A lot was in the form of loans or guarantees. Groups like Oxfam have pointed out that wealthy nations' generous accounting glosses over how little of that money is truly granted. By their analysis, the real support is far lower once you exclude loans that developing countries must pay back, often with interest. In other words, some climate finance is putting vulnerable nations into debt, making them pay for a crisis they did little to cause. There's also the issue of what gets funded. Of that $115.9 billion, only about $32 billion went toward climate adaptation, helping countries build resilience against floods, droughts, and storms. That's roughly a quarter of the funds, even though adaptation is urgent for survival in many communities. Most finance still prioritizes mitigation, like renewable energy projects, where investors can more easily see returns, leaving adaptation projects, seawalls, drought-resistant farming, disaster prep, underfunded. This imbalance is an unintended inefficiency. Mitigation is crucial, but without adaptation, billions of people remain extremely vulnerable to climate impacts already underway. So climate finance as a concept is about fairness and global solidarity, but in practice it's been slow, stingy, and skewed. Only recently are we seeing movement, like a new international fund for climate loss and damage to help disaster-hit countries, a victory at COP28 in 2023, but initial contributions to it are tiny. The UAE and Germany put in $100 million each. The US just $17.5 million so far. The scale of need is in the hundreds of billions per year, so current finance mechanisms still resemble a leaky bucket when a flood is coming. Finally, let's talk about carbon border adjustment mechanisms, CBAMS. It's a mouthful, but the idea is simple. If one country or group of countries is cutting emissions and pricing carbon, it doesn't want its efforts undermined by cheaper imports from places with lax rules. So a CBAM is essentially a carbon tariff. The European Union is spearheading this. As of October 2023, the EU's CBAM entered a transitional phase. Importers of carbon-intensive goods like steel, cement, aluminum, fertilizers, electricity, and more now have to report the embedded carbon emissions of those goods, and starting 2026, they'll have to pay a fee equivalent to the EU carbon price on those imports. It's a bold attempt to level the playing field, to prevent carbon leakage where industries might relocate, to evade climate laws, and to prod other countries to adopt their own carbon pricing. EU officials argue it's about climate fairness. European companies pay for their CO2 emissions, so foreign competitors should too, or else EU industry and climate goals both suffer. But as with our other climate tools, CBAMs come with controversies and potential side effects. Many nations see the EU's move as unilateral and punitive. Critics, especially in the developing world, call it a green tariff or even eco protectionism. They point out that the EU's carbon border tax could hit emerging economies hardest because those economies often export the very products on the CBAM list steel, fertilizer, cement as a big part of their GDP. The evidence backs this concern. Analysts found countries like Mozambique, Zimbabwe, and even Ukraine could be among the most affected in relative terms. Despite having little say in the CBAM's design, no exemptions were ultimately given for least developed countries, so a poor nation that hasn't implemented a carbon price will effectively see the EU impose one on its exports, with the tax revenue going to Brussels. In fact, the CBAM has been criticized as unfair under WTO principles, potentially discriminating against producers in countries with different capabilities. The common but differentiated responsibilities principle in global climate talks, meaning rich countries should bear more of the burden, doesn't exactly mesh with a flat carbon tariff on everyone. Another issue is practical. Measuring the carbon content of imported goods is complex. Importers will need to document emissions from foreign factories, which might not have reliable data. This compliance burden could overwhelm smaller exporters who lack the resources to calculate and certify their carbon footprint. And if they can't, they'll pay a default high tax, pricing them out of the market. The EU says CBAM will incentivize countries to adopt carbon pricing or cleaner production. Indeed, Turkey announced plans for a carbon tax after the EU move to avoid paying the border fee. But others see it as coercive, using the EU's market power to strong arm policy changes abroad. There's also an irony. While the EU has floated giving CBAM revenues to help poorer countries green their industries, as of now, those revenues are slated for the EU's own innovation fund. Critics note that without sharing the funds, CBAM doesn't help developing countries cut emissions. It just charges them, potentially violating climate justice ideals. In short, carbon border adjustments are innovative and could prevent backdoor emissions, but they risk igniting trade disputes and perpetuating a rich-poor divide if not implemented carefully. As one commentator put it, the EU's CBAM might be a benevolent provocation, tough nudge for a good cause, but it needs global buy-in to really work rather than becoming a new carbon trade war. We've unpacked a lot: carbon offsets, ESG, climate finance, CBAMS. All these tools are attempts to weave climate action into the fabric of economics. They reflect an important truth. Solving climate change isn't just about science. It's about incentives, money, and markets. Yet, as we've heard, each comes with pitfalls. Phantom credits that don't cut carbon, investments that badge themselves green without transforming companies, funding promises that fall short, tariffs that might unfairly burden the poor. It's a reminder that good intentions aren't enough. The details of policy design, transparency, and enforcement matter hugely. Now, zooming out, we step into the big picture chess game of climate geopolitics. Because behind every mechanism and policy, there's a question of power. Who gains? Who loses? Climate change may be a global problem, but the burden and benefits of climate action or inaction are unevenly distributed. Let's unravel that. One stark reality is that some players have profited immensely from the status quo, even as the world begins its green transition. Take the oil and gas industry. In 2022, while climate disasters multiplied, the world's biggest Western oil companies were enjoying record profits, a combined $219 billion for just the top 5 firms, more than double the previous year. High energy prices, exacerbated by the war in Ukraine, meant companies like Exxon, Shell, and Chevron made windfall revenues. They returned a huge chunk of that cash to shareholders, over $110 billion in dividends and stock buybacks in that single year, even as consumers struggled with high fuel costs and governments grappled with climate damages. This reveals a geopolitical tension: who pays for climate change and who profits from causing it. In 2022, it was hard to escape the contrast. Big oil reaped unprecedented rewards, while the global community paid the price in extreme weather and inflation. That's why there were growing calls in many countries for windfall taxes on these profits, to have fossil fuel giants compensate society and fund climate solutions. Some governments did impose temporary taxes or price caps, but the fundamental imbalance remains. The polluter pays principle is often invoked, yet in practice, polluters are still often paid by market forces, while the broader public pays for cleanup and adaptation. Meanwhile, those least responsible for climate change are bearing its worst costs. There's a bitter irony in geopolitics. Developing nations, from low lying island states to drought prone African countries, have tiny carbon footprints but face calamitous impacts. The question of who should pay for climate damages has become a moral and strategic flashpoint. At international summits, vulnerable countries have pushed hard and finally secured a loss and damage fund in 2023. This fund's aim is to funnel money to communities hit by irreversible climate losses. Think of Pakistan's apocalyptic floods or Pacific Islands losing land to rising seas. It's a landmark in climate diplomacy, an acknowledgement that somebody has to pay for the devastation. But here's the catch: when the fund was established, the initial pledges were tepid. The United Arab Emirates put in $100 million as the COP28 host, Germany another $100 million, the entire EU about $245 million, and the United States just $17.5 million. These amounts are drops in the bucket compared to the tens of billions in damage from a single extreme event. So the politics of aid comes into play. Richer nations fear open-ended liability. Poorer ones insist on climate justice, even as everyone publicly agrees we're in this together behind closed doors. It's a haggle over the bill, and climate aid can be used strategically. Donor countries might attach conditions or seek influence, and recipient countries maneuver to get funding without strings. It's a new arena of international relations, not quite charity, not quite reparations, but something unprecedented. Climate policies themselves have become tools of global strategy. Nations are deploying climate initiatives in ways that also bolster their economic interests or diplomatic clout. For example, the US passed the Inflation Reduction Act in 2022, which, despite its name, is essentially a $370 billion green industrial policy. Huge subsidies for electric vehicles, batteries, solar panels, etc. Ostensibly, it's about cutting US emissions, but it's also explicitly about reshoring, clean tech manufacturing, and outcompeting China in the industries of the future. This sparked tension with the EU, which fretted the US was unfairly luring green businesses, leading Europe to relax its own state aid rules and race to subsidize domestic clean tech. So we see a kind of clean tech arms race, climate action entwined with economic competition. China, for its part, has invested massively in renewable energy and now dominates solar panel and battery supply chains. That's not just because China cares about climate, though it has its targets. It's also a strategic move to be the world's primary supplier of the new energy economy. Climate cooperation and competition go hand in hand. At some moments, countries form alliances, like international pledges to cut methane or deals to conserve rainforests. But at other moments, they're jockeying for advantage. Who will sell the world electric cars? Who will control green hydrogen trade? Who writes the rules for carbon markets? Even the EU's CBAM we discussed is both a climate measure and a strategic one. It pressures other countries to adopt carbon pricing or face tariffs, effectively exporting EU's climate policy abroad. To some in the EU, this is just taking leadership. To others, like officials in India or South Africa, It's a power play by rich blocs to impose their standards. And then there's the dark side of climate geopolitics, the lingering specter of climate denial and delay. It's astonishing, but despite unequivocal scientific evidence, concerted campaigns to deny or downplay climate change have not fully gone away. Why? Because acknowledging the problem means someone's interests, often powerful, carbon intensive industries, will take a hit. For years, a handful of oil producing nations and corporations funded think tanks and lobbyists to cast doubt on climate science, hoping to stall action. That playbook has been largely exposed and discredited, but its effects linger in polarized political debates, especially in some Anglosphere countries. In the United States, for example, climate change became a partisan issue for decades, hampering policy. And as recently as the 2000s and 20s, you still hear some politicians claim that warming is a hoax or that cutting emissions will wreck the economy. However, the scientific consensus is overwhelming. Truly 99% plus of experts agree that human activity is driving global warming, and climate denialist narratives crumble under record temperatures and events. The data speaks loudly. 2023 was on track to be the hottest year on record, about 1.40 degrees Celsius warmer than pre industrial times, blowing past previous records. Greenhouse gas levels reached all time highs. The head of the World Meteorological Organization warned of a deafening cacophony of broken records as we saw unprecedented heat waves, ocean warmth, and polar ice melt. We are living climate science in real time now. Arguing that climate change isn't real or isn't caused by humans is about as credible as claiming the earth is flat. The case is closed. That said, a more subtle problem has emerged: climate delayism. Many actors no longer outright deny the climate is changing, but they push vague promises, future technologies, or minimal efforts, essentially kicking the can down the road. This too is strategic. It protects current profits and power structures while appearing to acknowledge the issue. Combating that requires calling out empty pledges and demanding concrete action. A key part of holding governments and companies accountable is exposing greenwashing, all those instances where entities talk a big green game while doing little or even undermining climate goals. We touched on this with carbon offsets and ESG funds. Let's look at a concrete example: the aviation industry. In 2022, Dutch airline KLM launched a Fly Responsibly campaign, suggesting that with initiatives like biofuel and offsetting, you could fly and still take care of the planet. Sounds nice, but climate activists challenged KLM in court for misleading advertising. And in 2024, in a landmark ruling, a court found that KLM's ads were indeed misleading greenwashing. The judges said KLM painted a too rosy picture about its sustainability measures, which in reality only marginally lessen environmental impacts, giving flyers the false impression that air travel could be guilt free. Essentially, the court agreed that no current measure makes flying sustainable. Airlines shouldn't claim otherwise. This case sent a ripple through the industry. Dozens of other airlines had similar eco friendly ads, and now they are on notice. More broadly, Europe's regulators are cracking down on greenwashing in everything from car commercials to banking. For instance, some asset managers have been fined for mislabeling investment products as green. Companies like automakers faced backlash for advertising clean diesel or eco friendly SUVs without proof, and many corporate net zero by 2050 pledges are under scrutiny. Are they relying on unreliable offsets? Are they investing in new oil fields while promising to cut emissions? The pressure is mounting to align words with deeds. It's easy to get cynical when you hear about all these failures and half measures, but it's not all gloom. There are success stories and hopeful trends emerging from this tangle of policies and politics. Look at renewable energy. Thanks to years of supportive policies and technological progress, wind and solar power are booming worldwide. In 2023, global renewable energy capacity grew by a record 510 gigawatts. That's a nearly 50% jump in new installations compared to the year before. Solar panels blanketed roofs and deserts from China to California at astonishing rates. China alone installed more solar capacity in 2023 than the entire world did the previous year. The International Energy Agency noted this spectacular growth offers a real chance to meet ambitious global targets, like tripling renewable capacity by 2030. If current trends continue, renewables are on track to overtake coal as the largest source of electricity by 2025. That's a profound shift in the global energy landscape and a positive one, achieved through a mix of market mechanisms. Renewables are often the cheapest power source now, and smart policies, mandates, feed in tariffs, and tax credits. Another example, in some regions, carbon pricing has worked to an extent. The EU's emissions trading system, after reforms, saw the price for carbon allowances climb high enough, over 80 euros per ton in recent years, that it's pushing utilities out of coal burning, contributing to Western Europe's coal use plummeting. Innovation is accelerating too. Electric vehicle adoption, battery storage, plant based alternatives, these are taking off faster than predicted, indicating that well designed incentives can shift behavior at scale. And don't forget international cooperation successes. The Montreal Protocol, a treaty to fix the ozone layer, ended up phasing out certain chemicals that were also potent greenhouse gases. It's often cited as proof that global environmental treaties can work. The ozone hole is healing, and we avoided a bunch of warming in the process. While climate change is a tougher, broader challenge, the principle stands: when nations truly collaborate, we can solve planetary problems. Still, every success has to be guarded against complacency. The renewable energy surge is encouraging, but we must ensure it displaces fossil fuels instead of just adding to energy use. Climate policies like carbon pricing or CBAMs show promise, but need a tweaking to be fair and effective. The underlying theme here is accountability and justice. Whether it's a corporation claiming to be green or a country setting a bold target, the world is increasingly saying, prove it. We're moving thread by thread, from lofty pledges to measured outcomes. So where does that leave our so-called climate cartel? In truth, it's not a single cartel at all. It's a sprawling tapestry of actors: governments, businesses, activists, citizens, all entangled in the climate fight. Some coordinate in good faith to raise ambition. Others collude in the shadows to water down action. We've seen how financial mechanisms can be powerful, mobilizing capital, penalizing pollution, but also how they can be gamed or fall short, requiring constant vigilance and reform. We've seen that climate action is not merely about cutting CO2, but about who controls the narrative and the purse strings. There will always be those who try to profit from the planet's predicament, and those who end up paying more than their share. Yet, there's also a growing coalition. Scientists, youth movements, forward-looking businesses, enlightened leaders working to realign our economic systems with our ecological reality. In this tug of war, being critical but fair is key. We must call out greenwashing and hypocrisy when we see them, armed with facts, and we've cited plenty, from 94% worthless offsets to 99.9% scientific consensus. But we also should celebrate progress, like record renewables and genuine climate finance commitments, to build momentum. The climate challenge can often feel like a story of daunting economics and power plays, but it's also a human story of ingenuity and cooperation. By pulling each thread, policy, finance, science, activism, and weaving them together, we can hopefully change the tapestry of our future. The climate cartel, in the end, should be us banding together to break the climate deadlock, not a conspiracy to prevent action. And with eyes open to both the pitfalls and potentials, we can push for the kind of systemic changes that turn all these market mechanisms and geopolitical maneuvers into a cleaner, fairer world. That's another thread pulled, but the fabric still tangled. If you found something worth thinking about, consider following the show and sharing it with someone who might too. You can listen to all episodes on Spotify, Apple Podcasts, or wherever you get your podcasts. I'm Dheeraj Kumar, and I'll see you next time as we pull another thread from the fabric of our world.